How much can I afford? How big of a house can I buy? Kind of a different question than how big of a house should I buy? Like, what is my budget? Which I want to talk about in a second. But what I really want to focus on today is how much can you buy? What's the limit? As a lender, I get asked that question all the time. My name is Nicole Rueth and I'm with the Rueth team, and I want to go through a very simple concept called debt to income ratio. Simple to me because I work with a lot of borrowers every single day and to help a lot of those borrowers turn into homeowners. But it's not a simple concept if you've never heard of it before, or if this is your first time purchasing a home. So I want to just break down this simple concept. What is debt to income ratio? Which is different than what is my monthly budget, right? Because I really want to just land there just for a second, because it's super important that when you're going out looking for a home, you've identified what is that monthly number, that monthly payment that fits with the rest of your lifestyle. Because it's really easy to fall in love with a house that's higher than your budget. I mean, the higher you go, the prettier they get, right? But that might not work with the fact that you want to start a family. You want to buy a car. You want to go on vacations. Maybe you want to build up investments to secure your financial freedom and retirement. All of those things should be talked about, discussed with your lender, bringing in all the other things about your life to ensure that you pick the house payment that allows you to have a life, not just live in a home. So let's go over, though, this part of it. Not the what should I limit my monthly payment to, but what is my monthly payment limited to? i.e., what is the maximum monthly payment I can afford based on a debt to income ratio? And the simplicity of the formula is just that. It's within each of those blocks where it can get a little complicated. But the formula itself is simple. It's just your total monthly obligations, your debt obligations, divided by your total monthly income. When I dive into those, that's where a little bit of the conversation goes. But that's the basic formula. And that you can even do at home, right? Pencil to paper math. What are my debts divided by what is my income? What is that limit of that monthly payment that I can afford? And I'm going to go over all of that together right now. So your debt to income ratio, let's start out first with the bottom number, your income. How do I figure out what that is? It's easier if you're a W-2 employee. It's really easy if you're a salaried W-2 employee. W-2 employees are based on the gross income. So if, say you have $100,000, or we'll make it even easier, $120,000 salary, that's $10,000 a month. Or if you have a $60,000 annual salary, that's $5,000 a month. If you're hourly, it's going to be based on your average hours over the last year. And that includes the overtime hours as well. So I'm going to look at what your average hours are over the year and divide that by 12. And maybe say you've been there a year and a half or a year and 3 months. I'm going to take all of that and I'm going to divide it by the number of months, and it can be a fraction of months that you've been on that job. If you've been on that job a long time, I'm just going to look at either the last 1 year or the last 2 years, depending on the program that we choose. So that's how I decide on if you're a variable hourly employee or a salaried employee. Or what if you have bonuses and commissions? That's great. I can include those too, as long as I see that you have at least a full year of them. And again, depending on the program, 2 years. So say I get a $10,000 a year bonus. Well, I can include that with the income that maybe is my salary. So maybe my salary itself is $110,000. But because I get a $10,000 bonus every year, I get to throw that in. That's 120 divided by 12. I get to use $10,000 a month. Now, the self-employed people is where it gets a little complicated. Self-employed, it's the net income. because we have to see what are all those business expenses that you write off. So you take in gross receivables and then you write off expenses, whether that's meals or travel or marketing or advertising, any of those things, and then you have a net income. Whether you're self-employed as an individual on your Schedule C, on your personal tax returns, or you have an LLC and you've graduated to a C Corp or an S Corp. Now a C Corp, you're gonna go back to being a W-2 employee. That's getting a little complicated, and I don't want to complicate this. I just want to say that if you're self-employed, we're going to be looking at that net income, and the different company types could change that a little bit. But if I'm looking at your net income if you're self-employed, say you have $120,000 of gross receivables. You'd be like, great, that's $10,000 a month. But it's not. If you have $60,000 in expenses because you're self-employed, you have the right, and really it's a good thing to be able to write all of those expenses off, so you're taxed on a lower amount. But remember, a lender can only use that income that you're taxed on. So if you write off a bunch of stuff to lower your tax returns, that's also going to affect how much you qualify for. So if you have $60,000 in expenses, that drops that $120 down to $60,000. I can only use that $5,000 a month, that net income. Really important. And if you want to go through your tax returns because you're self-employed, then give me a call, send them over, we'll walk through it together. I'll tell you exactly what your net income lands at. So going back, I'm going to take that monthly income number, whether it's the gross number if you're W-2, whether it's the net number if you're self-employed, and we're going to put that on the bottom. Then I'm going to look at what is your total monthly obligations. And that could be, it's this new mortgage payment that you're qualifying for, plus the other stuff I see on your credit report. So like your car loan, student loans, and that's a whole nother video where we talk about how do you calculate student loan payments. But let's just assume you have some student loans, and for right now, there's a payment that's on your credit report. That's what I'm going to pull. I'm not looking at what is your cell phone bill, what is your cable bill, what are those things that don't enter onto your credit report, but you have them because you pay your water bill and your utilities and your cable bill, but they don't show up on your credit report, so we don't count them. We're only looking at the debts that show up on your credit report. So it could be your student loan payment, your minimum monthly payment on your credit cards. Maybe you pay off your credit cards every single month and you're thinking, well, my monthly payment for that credit card is $1,500 because that's usually about the balance you run up every month. That's not the case. We're going to be going to the credit report to see what's the minimum monthly payment, which you can also see on your monthly statements. So we're also going to get your car loan if you have one, or any other personal loan or installment loan obligations. All of those we're going to pull off of your credit report. Here's a big thing to think through. If you're a cosigner on somebody else's card, car, or other obligation, that's also going to count against you. Now, if you are a cosigner, say on your parents' credit card still, and they put you on when you were in college and you just left it that way and it's been years, well, you have a choice. You can remove yourself as an authorized user, or we can get 12 months of bank statements from your parents showing that they pay that bill. And you can do that with student loans and car loans and anything else for that matter. But we would have to have 12 months of bank statements showing that somebody else is making that monthly payment instead of you. But if that's the case, I can remove them. If not, in the authorized user case, we can just remove you from that credit card in order to qualify you for more. So I'm looking at those monthly obligations. So in this case, if it's $2,300, maybe it's a $1,500 new mortgage payment, it's a $500 car payment, and it's $300 in monthly credit card minimum payments. So that $2,300 divided by the $5,000, because you earn a $60,000 annual salary, gives us our debt to income ratio. In this case, it's 46. Is that good or bad? It depends. So a lot of people like to say, I'd like to keep my house payment below 30% debt to income ratio, or 30% of my income, because that goes more towards budgeting. Because I want to control my monthly payment, because I do want to do all those other things. You want to go to the mountains and go skiing. You want to go overseas and go traveling. You want to do all those things that make life fun. So your budget is a top consideration and should be a conversation. This is going to be your limit. So 46%, again, I asked the question, is that good or bad? And that answer of if it depends is based on the loan product that we put you in. And the loan product we put you in has a lot of factors to it. What's your credit score? What are you buying? Is it a condo or townhome or single family? Are you a veteran? Is it in a rural area that a USDA loan would be great? Is it a high dollar purchase price that we have to go with a jumbo loan? Or is it in a conforming loan limit area? All of those things are going to be taken into account when we design the right loan solution for you. But 46, good, bad? Let's talk about the loan products. So if we're doing a conventional loan, if I'm manually underwriting, we're looking at a total debt to income ratio closer to 43%. But the 45% is a limit for a lot of down payment assistance or Home Possible or Home Ready. Some of those income-based loan products have a debt to income ratio limit of 45. But your typical standard Fannie Mae and Freddie Mac debt to income ratio limit is 50. So a lot of times I can go up to 50%. That means in my previous case, if I had a $5,000 a month gross income, then I could have up to $2,500 a month in debts. See, so if you're doing this at home and you know what that monthly income is and you know you're on a $60,000 a month salary, then you have to look at all your monthly debts that you know report to your credit report, and then you subtract those first, and then you end up with what your maximum mortgage payment is. At that point, you can make some decisions. Do I refinance that car to get a lower monthly payment? Do I pay off some of those credit card bills? Do I remove myself as an authorized user from my parents' credit card? Any of those things to help give you more wiggle room in what is left over. So that's conventional, and it pretty much has a hard stop. Now, Freddie Mac, interestingly enough, rounds down. So I can go up to a 50.49. So if I had a 50.5, it would, or just under that, it would round down to 50%. It's just an interesting play, especially if I have somebody that's right on the edge. Fannie Mae has a hard stop at 50%. So let's flip over what if you have an FHA loan. Now you're typically going to find that it stops in a range of 50 to 55% total debt to income ratio. Now that's not just the house payment. If you have a house payment of over 50%, it's going to be hard pressed to get that approved. But if I have some student loans and credit card debts and car loan on top of a house payment and it all lands in that 50 to 55 range, it still should work based on the compensating factors. Compensating factors like, do I have any money in reserves left over after I buy the house? Do I have a good credit score? Do I have any retirement accounts? All of those things kind of go into compensating factors. How long you've been on the job is another one. So 50 to 55%. Now I will say I've seen approvals as high as 57% with a really strong credit profile and reserves. Good to know. VA has the most relaxed, the most generous debt to income ratio range. Now here we have 55% as a limit, and I would say that that's probably a norm. I've seen it go all the way up to 65, 67% debt to income ratio. VAs are more heavily focused on residual income over debt to income ratio. And that is going to have to be another video. But for today, just know you have much more flexibility as a VA loan than you do FHA or conforming. And it goes kind of in that order, right? VA is the most flexible, FHA is a second, and then conventional is going to have kind of the tightest box. And then the subset of conventional is jumbo. Now, jumbo used to stop at a hard stop at 43%. And we just rolled out some new jumbo programs that go all the way up to a 50% debt to income ratio with no reserves in the savings account. Great news on that. Well, I hope that helped, because that's all we're going to go over today. My name is Nicole Rueth with the Rueth team, and if you have any questions around lending at all, make sure to ask them below. Make sure to comment, to like, to subscribe, and hit that little bell to make sure you get notified next time we put out a video. It was my pleasure, and I look forward to talking to you soon.